thing that nobody in finance wants you to figure out on your own. The bank doesn't make money for you. The bank makes money off you. And the moment you understand that, really understand it, not just nod at it, your entire relationship with money changes forever. I've watched people spend 30, 40 years handing their capital to institutions, paying interest to strangers, begging loan offices for permission to use their own financial momentum. Then they retire and wonder why the math never quite worked out. I'm not here to make you feel bad about it. I'm here to show you the exact mechanisms that wealthy people, the ones who don't talk much about what they do, use to keep capital moving inside their own ecosystem, not inside a bank's ecosystem, their own. We're talking about 3 specific tools today. I'm going to explain them the way I wish someone had explained them to me, without the sales pitch, without the jargon fog, and without pretending these are magic tricks. They're not magic, just logic. And logic, applied consistently, builds extraordinary wealth over time. Stay with me for the next several minutes. What I'm about to show you is the most practical financial education most people never receive. Here's a mental model I want you to hold on to. Think of a river. Water flows in, water flows out. The bank is the dam. Every time money moves through your life, your paycheck, your mortgage, your car loan, your credit card, your business line of credit, it flows through that dam first. The bank skims the difference, always. Now here's what the wealthy figured out. What if you build your own dam? Not to stop the river, to redirect it, to let the water move, let it grow, let it compound, but have you control the infrastructure instead of a faceless institution? That's what being your own bank actually means. It's not about burying cash in your mattress. It's not about crypto, though that's a different conversation. It's about building private financial infrastructure that mimics what banks do, except the profits stay with you. There are 3 serious, legitimate, IRS-recognized ways to do this. And when I say IRS-recognized, I mean there are actual tax code provisions that encourage this behavior. The government built these tools into the law. Most people never use them. That's their loss. Let's go through each one carefully. I'm going to give you not just the what, but the why. Because if you understand the logic, you'll never be confused about how to use them. The one everyone gets wrong, I know. The moment you heard life insurance, half of you flinched. That's understandable. Life insurance has a reputation problem. And it earned that reputation honestly. Because for decades, commission salespeople oversold it, mispriced it, and aimed it at the wrong goals entirely. So let's clean up the confusion right now and talk about what this tool actually does when it's set up correctly. The legal foundation here is Internal Revenue Code Section 7722. That's not a loophole. That's not a gray area. That's a provision written explicitly into federal tax law to allow certain life insurance policies to grow and distribute money under favorable tax treatment. Congress put it there. The IRS acknowledges it. Your accountant should know it by name. Here's the structure. You take out a permanent life insurance policy, not term, permanent, and you overfund it, meaning you pay more than just the base cost of the insurance coverage. That excess money doesn't disappear. It accumulates inside the policy as what's called cash value. Now, here's where it gets interesting. That cash value grows. It grows either tied to market indices in what's called an indexed universal life policy, or IUL, or through dividends from the insurance company's general fund in a whole life policy. Either way, it grows tax-deferred or tax-free depending on how the policy is structured and how you access the money. But the real power is what happens next. You can borrow against that cash value, not withdraw, borrow. This distinction is everything. When you borrow against your cash value, 2 things happen. Simultaneously, that should make you stop and think. First, the loan proceeds come to you tax-free. You're not touching the principal inside the policy. You're borrowing against it. The IRS doesn't count that as income. Second, and this is the part that sounds too good to be true but isn't, the cash value inside the policy keeps growing as if you never borrowed a cent. Let me say that again because it deserves repetition. The money stays in the policy growing, and you also have the money in your hand deployed into an investment. You're simultaneously earning the return inside the policy and putting the borrowed capital to work elsewhere. That's leverage, real leverage, the kind that compounds quietly for decades. Let's put numbers to it. Imagine your cash value is at $200,000 growing at 7% annually. You borrow $120,000 against it at a policy loan rate of around 4%. You deploy that $120,000 into a real estate investment generating 12% returns. You are now earning 7% on $200,000 inside the policy, plus 12% on $120,000 outside it, while only paying 4% in loan interest. The spread between what you earn and what you pay is how you win. Banks do this every single day. Now you're doing it, and when you die, the outstanding loan balance gets paid back from the death benefit automatically. Your family receives the remainder tax-free. You may never have formally repaid that loan, and it didn't matter because the structure handled it. No credit check, no loan application, no approval waiting period, no banking officer deciding whether your collateral is sufficient. You are the decision maker. Now here's the critical warning, and I cannot stress this enough. This tool is massively misused by the people that sell it. The incentive structure in insurance sales is deeply misaligned with your interests. An agent earns higher commissions on higher death benefits, but a higher death benefit means more of your premium goes toward insurance cost and less goes toward cash value accumulation. If you're using this as a banking tool, you want the opposite. Maximum cash value growth, minimum death benefit required by law to maintain the tax advantages. Before you sign anything, look at the cash surrender values in the policy illustration. If you put in $50,000 in year one and the surrender value was $35,000, that gap went to someone's commission. That's not a policy designed for your benefit. That's a policy designed for the agent's benefit. Work with someone who has a fiduciary obligation to you. Ask to see the internal rate of return on the cash value specifically. Compare multiple illustrations. Be skeptical of anyone who leads with the death benefit instead of the cash value growth. Used correctly, this is a generational wealth building engine. Used incorrectly, it's an expensive lesson. The retirement account nobody thinks to borrow from. Let me address the question you're already forming in your head. Why would I borrow from my retirement savings? Isn't that financial suicide? I understand the instinct. Most of the financial advice culture around 401ks is built on one message. Put money in, don't touch it, let it compound for 40 years. And that's generally good advice, but it's incomplete advice because it ignores the specific, legal, tax-neutral mechanism that allows you to access that capital without triggering any of the penalties or tax consequences you're afraid of. Here's the distinction that changes everything. There is a massive difference between a 401k withdrawal and a 401k loan. A withdrawal? Yes, that's usually a disaster. You pay ordinary income tax on the full amount plus a 10% early withdrawal penalty. If you're under 59 and a half, that could mean losing 30–40% of your money immediately to taxes and penalties. A loan? Entirely different. The IRS treats it like what it is. A loan, you borrow from your own account, you pay it back with interest, and at no point is the transaction treated as a taxable distribution. The money never left the retirement system, it just moved from your account to your pocket and back again. Here are the specific rules because precision matters here. Most 401k plans that allow loans let you borrow up to $50,000 or 50% of your vested balance, whichever is less. You typically have 5 years to repay. The loan, the interest rate is generally set at the federal applicable rate, AFR, which right now sits around 4 to 4.5%. And the critical part, you pay that interest back to yourself. It goes back into your own retirement account. The bank earns nothing. Think about what this means practically. You have $200,000 in your 401k growing at 10% annually. You need $50,000 for a real estate down payment or to eliminate $50,000 in credit card debt charging 22% interest. You borrow $50,000 from your 401k at 4.5%. Your account still has $200,000 in it. The loan shows as an asset within the plan. You are paying 4.5% interest to yourself. You are eliminating 22% interest you are paying to a bank. The is not subtle. That's an effective gain of nearly 18 percentage points on that capital. And here's the piece that rarely gets mentioned. When you pay back that loan with interest, the interest goes back into the account. So your future self, the one who will retire and live off this money, is being paid by your present self. The same dollar is doing two jobs at once. This strategy is particularly powerful for solo entrepreneurs and small business owners who have established a solo 401k. The solo 401k is one of the most underutilized financial tools for self-employed people. You can contribute significantly more to it than that traditional employer-sponsored 401k. and it offers the same loan provisions. If you're running your own business and you don't have a solo 401k set up, that's a conversation you need to have with a qualified tax professional this week, not next month, this week. Important constraint to acknowledge, honestly. This is best used for short-term capital needs, bridge financing on a real estate deal, business startup costs, debt elimination, not long-term capital deployment. A 5-year repayment window matters, and if you leave your employer before the loan is repaid, the outstanding balance typically becomes due quickly. Know the terms of your specific plan before borrowing. But for the right situation, this is low-cost, fast, and entirely self-contained capital. No bank needed. No approval required beyond your own plan administrator. The strategy most people don't even know exists. This third tool is where things get genuinely sophisticated and where the people who understand it pull dramatically ahead of those who don't. If you own a business, an S-Corp, a C-Corp, an LLC, any closely held entity, you have the ability to create a private lending relationship between entities you own. Your business can lend money to another business. Your holding company can lend to your operating company. Your safe asset LLC can lend to your active investment entity. And this lending structure can be made to serve you in multiple ways simultaneously. Let's break down why this is so powerful. First, the interest income stays inside your ecosystem. When your LLC lends $100,000 to your corporation and charges 5% interest, that $5,000 in annual interest income goes to your LLC, not to a bank. It stays with you. The corporation gets to deduct the interest as a business expense, reducing its taxable income. Your LLC earns that interest as income. You control both entities. The money circulates within your own financial universe. Second, this can be a serious asset protection mechanism. Here's how that works. Say you have capital sitting in what I'd call a safe entity, an anonymous LLC in a state like Wyoming, which provides strong charging order protections and has no public ownership records. That entity has no active business operations, no employees, no contracts, no liability exposure. It's just holding capital. Now you want to deploy that capital into an active deal, maybe a house flip, maybe a hard money lending arrangement, maybe a commercial real estate acquisition. That active deal carries risk. Things can go wrong. Instead of having your safe entity directly own the active deal, which would expose your capital to that risk, your safe entity lends to the active entity. The active entity takes the risk. Your safe entity holds a secured promissory note. If the deal fails, your safe entity has a legal claim as a creditor, a position with priority over general creditors and equity holders against the assets of the failed entity. You separated the capital from the risk legally and structurally. The money is still in the game, but it's protected. Now, because this involves related parties, entities you own, the IRS scrutinizes it. That's appropriate. You cannot simply fabricate a lending arrangement on paper to move money around and call it a deductible expense. The IRS will call it what it actually is, a disguised distribution, and you don't want that. To make this work properly, you need to do it properly. That means a real signed promissory note with the loan amount, interest rate, repayment schedule, and collateral stated explicitly. Not a handshake, not a memo to your file, a proper legal document. An interest rate at or above the applicable federal rate, the AFR, which the IRS publishes monthly. This is generally 4 to 5% in the current environment. Using a rate at or above AFR means the IRS cannot argue you're hiding a gift or a distribution inside a fake loan. Actual repayment behavior. The corporation makes real payments on the schedule. Bank records show real transfers. If you never make a single payment and years pass without any movement, the IRS has grounds to recharacterize the whole arrangement. This isn't complicated, but it requires discipline, and it requires working with an attorney or CBA who understands related party transactions. When it's done right, you have created a private credit system where you are simultaneously the lender and the ultimate beneficiary of the borrower's success. The interest builds wealth inside your safe entity. The borrowing entity gets capital at reasonable cost. Risk is compartmentalized, tax efficiency is maintained, and not a dollar of unnecessary interest leaves your ecosystem to enrich a bank's shareholders. I want to mention 2 additional instruments quickly because I've watched intelligent people overlook them simply because they weren't paying attention. The home equity line of credit, HELOC. If you own a home with significant equity, you have a credit facility sitting dormant that most people treat as emergency-only capital. That's a waste. A HELOC gives you access to low-cost capital, typically around 7 to 8% in current conditions, but often lower on a promotional basis, secured by your home's equity. But here's what almost nobody thinks about. The interest on a HELOC used for investment purposes is deductible as an investment expense, not as mortgage interest. That changes the effective cost significantly. You're not writing it off as a Schedule A mortgage deduction, which has limitations and phase-outs. You're writing it off against investment income, which is a different and often more valuable deduction. If you deploy HELOC capital into a real estate investment, the interest expense gets deducted against the income from that investment. The government is subsidizing your cost of capital. Use it. The securities-backed line of credit. JOS block. This one is almost entirely invisible to people who haven't reached a certain level of investment portfolio size. But if you have a meaningful portfolio of publicly traded securities, stocks, bonds, ETFs held at a major brokerage, you almost certainly have the ability to borrow against that portfolio at rates significantly below what a bank would charge on an unsecured loan. This is called a securities-backed line of credit. The mechanics are straightforward. Your securities serve as collateral. The brokerage extends you a credit line, typically up to 50–70% of the portfolio value, and you draw on it as needed. The interest rate is generally favorable because the collateral is liquid and easily valued. Major brokerages, Morgan Stanley, Raymond James, Fidelity, Schwab, all offer this. The critical insight is this: your portfolio keeps compounding while you borrow against it. You do not have to sell positions, trigger capital gains, or disrupt your long-term investment thesis. You simply use the portfolio's value as the basis for accessing capital, deploy that capital, repay the line, and your original positions remain intact. This is how large investors acquire assets without ever showing up to a bank's loan committee. Cash offer in 24 hours, secured against a portfolio that keeps growing. The bank never enters the equation. Let me step back for a moment and talk about what's really happening when someone masters these tools. It's not about being clever. It's not about finding loopholes. It's about understanding one fundamental principle that most people spend their entire financial lives ignoring. Capital is most powerful when it is circulating, not sitting. Every dollar that sits idle in a savings account earning 0.5% while you pay 22% on a credit card is losing ground. Every dollar you surrender to a bank as unnecessary interest income is a dollar that cannot compound inside your own system. Every time you go to an outside institution to borrow money you could have borrowed from yourself, you are giving away a portion of your financial future. The strategies we've covered today, cash value life insurance under Section 702, 401k plan loans, related party business lending, HELOC deployment, securities-backed credit, are all expressions of the same underlying logic. Keep the capital inside your ecosystem, control the flow, earn the spread, eliminate unnecessary assuting, control the flow, earn the spread. Intermediaries. This is not about becoming anti-bank. Banks serve legitimate purposes, and there are situations where institutional financing is the right tool. But the choice should be yours, made with full information, not a default born of ignorance. The wealthy don't have access to different assets than you do. They have access to different knowledge. Knowledge about how capital actually works, about which tax codes protect their strategies, about when to borrow from themselves instead of from a stranger, about how to make the same dollar serve multiple purposes at the same time. That knowledge is not secret. It's not restricted to people with a certain net worth or a certain background. It's available to anyone willing to learn it and apply it with discipline. I would be doing you a disservice if I ended there without being direct about the risks. These tools are real, they work, but they can be misused, and misuse is expensive. Cash value life insurance is a long-term commitment. The cost structure in the early years means you need to stay in the policy for a decade or more before the math fully works in your favor. If you surrender the policy early, you may recover less than you put in. Choose policies designed for maximum early cash value accumulation, not maximum death benefit or agent commission. Borrow and pay loans have tax consequences if they go wrong. If you leave your job or if the loan defaults, the outstanding balance may be treated as a taxable distribution, meaning you owe income tax plus potential penalties. Understand your plan's specific terms before borrowing. Related party lending must be done by the book. Sloppy documentation, missing payments, or below-market interest rates will draw IRS scrutiny and could result in the entire arrangement being recharacterized. This is not a tool for the disorganized. Invest in proper legal and accounting support. HALOCs use your home as collateral. If the investment you funded with HALOC capital fails, the liability to your home remains. Understand your risk exposure before pledging your primary residence. Securities-backed lines of credit carry margin call risk in volatile markets. If your portfolio value drops significantly, the brokerage may demand immediate repayment of part of the line. If you cannot repay, they liquidate your positions. In a severe market downturn, this can create a catastrophic cascade of losses. These risks are manageable. They are not reasons to avoid these strategies, but they are reasons to approach them with clarity, proper professional guidance, and appropriate position sizing. Never borrow more than you can service comfortably. Never deploy capital into risks you haven't fully analyzed. There's a principle I've believed in for most of my adult life. The quality of your financial decisions over time is determined almost entirely by the quality of your understanding, not your income, not your luck, not who you know. Understanding. Most people outsource their financial understanding to institutions that profit from their ignorance. Banks profit when you don't know how to self-finance. Insurance companies profit when you don't know which policies serve you versus which serve the agent. The government profits when you don't know which tax code provisions are available to you. The three tools we've walked through today: borrowing from your own life insurance cash value, accessing your own retirement account strategically, and building private lending infrastructure within your own business entities, are not obscure or experimental. They are well established, legally sound, and used consistently by the wealthiest families and most sophisticated investors in this country. The gap between those people and everyone else is not capital, not talent. It's knowledge applied with patience and discipline over time. You now have the knowledge. The rest is up to you. If this changed the way you think about capital, share it with someone who needs to hear it. And if you want to go deeper on any one of these strategies, the tax specifics, the entity structures, the policy selection criteria, that's a longer conversation worth having with a qualified professional who can look at your specific situation. Because the best financial strategy in the world is only as good as the execution. Think carefully, move deliberately, and make your capital work as hard as you do.